Okay, hello and welcome to another one of these Inside Nobody live streams. My name is Barry O'Reilly. I'm the Chief Incubation Officer at Nobody Studios, and it's fantastic to have everybody join us again. This show is one actually being quite excited about, and one we get a lot of questions about, is really about the understanding of the finance side of venture studios, or more particularly the equity crowdfunding that we're offering at Nobody Studios. So I'm delighted to join the master of bean counting himself, Mr. Greg Lovett. How are you doing, sir?
Yeah, good. Thanks, Barry.
So,
Yeah.
Greg, it's obviously, I always joke, you actually make accounting fun, which is always a joy for me working in these types of businesses. Can you tell people a little bit about your background? You've been an entrepreneur, you've been a CEO, you've run lots of little companies. Maybe just a chance to get to know a little bit about you.
Yeah, sure. Yeah. Um, so as you mentioned, I've been a serial entrepreneur for probably 25 years now. I've held basically every role you could hold. The only thing I haven't done is written code. So I've managed people who've written code. I've obviously done all the finance, accounting, operations. I've been CEO, COO, CFO. But in every role, typically I've always held the CFO function, and I'm one of those weirdos that likes it. So I take joy in closing my door and running
You
financial
spread joy
models.
with it.
Yeah,
So
exactly. So yeah, no, it's fun.
brilliant.
Yeah.
So what we're going to do today is actually give people a little bit of an overview of, first of all, understanding a little bit about crowdfunding, what it is, what it means, what equity crowdfunding means in the studio, but also the opportunity for folks who do get involved, who do invest in our equity crowdfunding, so they understand what they get. So I'm looking forward to you sharing that with people. But just before we dive into that, I think it's good to give people a little bit of sort of the origin or the history behind these types of new funding mechanisms. So we'll just share a little bit about that, and how the founding and the future of sort of funding companies is starting to look. So back in the good old days, when people were trying to start businesses, there's been various different iterations, if you will, about what funding companies is like. And we often think of them as sort of being like four more major ones. In the very earliest beginning of time, back in, I don't know, like 40 years ago, no, I'm not joking. But for most entrepreneurs, when they ever started a business, when they had an opportunity, an idea, and to get capital, the first thing that they have to do is find a way of actually going to a bank and asking a bank manager. And you could imagine when an entrepreneur comes in with like a crazy idea to sort of explain to people, this is the business I'm trying to create. I'm doing 100 companies over the next 5 years. Most bank managers will probably look at you and go, I have no idea what this person is doing, and sort of reject you, right? Or especially marginalize many people. And as time sort of started to progress, what happened is a lot of entrepreneurs then started to have a lot of success. And instead of then thinking about, well, with all this excess capital we have, rather than people having to go to banks, we could support entrepreneurs ourselves. And this was sort of the beginning of the early stages of the venture capital world, where entrepreneurs had extra capital, they understood entrepreneurs, and they wanted to try and invest in those entrepreneurs because they felt like they could manage that risk or they could support the community. And that was where the beginnings, if you will, of venture capital started to happen. But as more people wanted to try and get into this system and sort of start this exponential curve about changing the way finance can happen, new innovations started to happen. So not only just relying on venture capital companies, but we had the first introduction of crowdfunding. But crowdfunding sort of version one was literally where instead of you went to an entity like one company, you could speak to a population, a community, a crowd who would fund your company. But you wouldn't actually fund the company, you were buying the product. So for most people who are probably familiar with WeFundMe or a Kickstarter campaign, when you were buying into those campaigns, you didn't own the company. You were sort of paying in advance for the product. So probably the Pebble watch is one of the most famous sort of examples from Kickstarter, where it was this sort of a biometric watch that people could buy into. But you never owned the company. You were paying forward the money for the product to be built. And then that gave the capital to that company to go and build that product. And in return for you sort of betting on them to build the product, you got it. You got to own the product, but you never got to own the company, right? So this was sort of like the first innovation, if you will, in that space. And then today, now we're going to a whole new level of, if you will, ownership and community funding, where right on the sort of outer edges of innovation, you have the notions now of non-fundable tokens or NFTs or Web3, where literally communities can sort of fund these communities by buying or purchasing these tokens, which is, again, highly innovative and highly risky at this stage. But it's another way where the people who fund these communities actually own the community. And they are stakeholders, they own tokens, they can be distributed sort of dividends for whatever those companies start to create. So things like Bored Ape Club is a really interesting example where you have this community of people who are creating a brand, and as they sort of make items in that brand, they can distribute those dividends back to the community. And Nobody Studios is kind of an interesting innovation in itself because we're doing equity crowdfunding. So we're sort of in this interesting space where we're not necessarily right out there on the Web3 world, but we're different from a typical crowdfunding because you're not funding us to essentially pay for a product that we're going to send you. You're going to actually own a piece of the company, right? So this is a really sort of fascinating world and space that we're starting to move into now, where people can have greater ownership of companies, and the crowd can actually own companies, which is a really fantastic innovation. We're really proud to be one of the first venture studios to ever offer this to people, which is, again, creates agency, it creates opportunity for people to get involved in early stage companies, and something that's really innovative that we're really proud of. So Greg, do you want to share any more here and just some of your insights going through the process?
Yes, absolutely. It's interesting, right? Because we're talking about the kind of the general crowd being able to get involved in these types of investment vehicles, because historically there's been a number of individuals who've gotten involved, right? But they're high net worth individuals. I mean, all throughout my career, when we're pulling an investment, that was actually one of the big things we had to do, was to make sure that whoever was investing was accredited, right? So for those who aren't familiar with that term, it basically means you make a certain amount of money per year, which is much larger than the average, American would make, let's say, since these rules are in the US. That's why I'm talking about America. Or you had a certain amount in the bank, right? So these two kind of major thresholds would allow you to invest in these types of vehicles. And it's only now that kind of these things are opening up and allowing everyone to invest in them. The absurdity of that is that, if you're in the States, you are a drive or a flight away from Vegas, where you could literally withdraw your entire life savings, go spend it in one night on the one-armed bandits, right? But you cannot, do your research on a company with a solid team and invest in them. That's historically the way this has worked. So it's good these things are opening up. It's not quite as open as most of us think it should be at this point, but for what we're doing with this crowdfunding, it's good. It's a good time to be an average investor.
Right. So before we dive into some of the nuts and bolts in this, you have a small little public announcement you wanted to make to people, just for give them a chance to make sure they got reading glasses on. And
this is what you get when you ask an attorney to give you just a couple sentences to let people know that these things we'll be talking about are based on assumptions. This is what you get. So we won't spend a lot of time on this because it's silliness. If you want a copy of this later, just email me. If you're having trouble sleeping, these are good things to read through. But let's dive in. Yeah. As Barry mentioned, we are, involved in a crowdfunding where people are going to end up with a portion of the studio. So what this graphic is trying to convey is that you've got yourself as an investor are investing in the studio structure, which in your mind's eye, if you're familiar with the term, like a parent versus like its subsidiaries, That's kind of what you're investing in. This is very different from, let's say, like a venture capital structure. So a venture capital structure is when you invest in that, you're investing in like a particular fund. And so, venture capital firms who've been around a long time, they could have, 8, 9, 10 funds by now. And if you invest in the 10th fund, you won't get any benefit from the things that happen from the 1st through 9th fund. Conversely, if you invest in the first fund, you'd have to invest in subsequent funds to benefit from anything that happens there. So what we're doing is different. If you invest into the studio and you hold your shares, you will have your pro rata piece of everything we do from here on out. And that's what this is trying to convey. And so all the companies on the right. And then as those companies go through exit events, you as the investor participate in that. But let me walk you through what that means when we say exit event and when we're talking about funding. Let's dive into a little bit more detail there, because it might not be as obvious as we live this stuff, so it's easy for us to think through this, but it might not be as obvious for everyone out there. So when you take a look at a particular company, not the studio, but one of our portfolio companies, let's say Thought Forum or Ovations, you've got these different rounds of funding that those particular companies would expect to go through. So the Nobody Studios investment, right? This is us for funding what we call the progressive model. So there's these different phases that projects go through within the studio, and we make the call to keep funding a particular project based on its merits. If it's not working, we will end it, and the companies that are doing well will continue to fund them, wrap a team around them, and then spin them out. So when we spin them out, that's when they start to get third-party funding. In other words, funding from separate entities, not the studio. So they could go through a seed round, a Series A round, Series B round. All these things mean is that they're really just going through a first, second, third, fourth, fifth round of funding. Generally, you would expect to see that portfolio company's valuation rise at each round, and you'd expect that the amounts that are being invested into those portfolio companies would also get larger. That's generally speaking how this works. There are, as you can imagine, a lot of variations to that. So when we talk about an exit, this particular portfolio company example that you're looking at here, they could go along and then exit the studio, take in a seed round of investment, take in a Series A round of investment, and then go through an exit event. So they're acquired, or they might go public, let's say. Or it could happen after the Series C round. It could happen after the seed round. But that's what we're talking about when we're talking about an exit event. So let's take a look at when that happens, what investors could expect to receive as far as returns. So we'll take a look at, again, a single portfolio company. So the studio has got multiple, and then one goes through an exit event. What could that look like to an investor? So we look at, we have all these models, low, medium, high models. So we'll just take like a medium valuation model. And we'll say that this particular portfolio company went through the studio's cycles, got a seed round, then a Series A, then a Series B round, and then exited. And when it was, let's say it was acquired. And when it's acquired, let's say it generated $90 million as far as an acquisition price. At that time, again, just another assumption, let's say the studio owned 30%, because initially it owned 100%, but as it went through rounds of investment, the studio got diluted a little bit. So now we own 30%. So that would mean we have $27 million that's coming to the studio from this particular portfolio company having gone through its exit. So when that happens, what we do with the money is formulaic. So we retain certain amounts. 8 million in this example would be retained. We pay back the studio for its investment, and we take 30% as a reinvestment fee. So this is how we continue to build new portfolio companies over time. And then the rest is distributed to the shareholders. So everyone in the company that's a shareholder. And so in this case, that would be 19 million. So if we take a look, just as an example, at an individual who, let's say, invested $1,000 in this crowdfunding round, based on the crowdfunding being completed in an angel round that we just went through, this investor could expect to get almost half his or her investment back just with this single portfolio company going through an exit. So that's what we're trying to build here, right? Is we're trying to build a distribution paying machine. So unlike a typical investment where you invest in a stock, you go to E-Trade, you buy some Apple stock, and you want that particular stock to go up, and then you'd sell it at some point. This one is a really different play. It's more like you want to hold the stock and then get these distributions over time. In your mind's eye, think of it like a dividend, if you're familiar with that concept. So again, some publicly traded companies, they pay dividends year over year. That's kind of what you'd expect. It's a different construct, but that's kind of a similar model in that really the value to what we're going to do is in the holding. Certainly the value of the equity of the studio's equity should increase dramatically over time, but that's not really where you'd make a lot of money. So for this particular investor who did $1,000, again, we have these kind of low, medium, high models. Over 5 years, he or she could expect to get from $4,000 to $8,000 back in just distributions. And in 10 years, the numbers move to $24,000 to $55,000. Again, these are based on a lot of assumptions on how many companies we're going to develop, how many of those companies will succeed. But these are fairly conservative assumptions sitting behind these numbers. So that's why we feel fairly confident in walking everyone through this. And as we said here, this does not include the value of your equity in the studio. This is just the distribution. So you would still hold your shares. And as these companies exit, you would continue to receive the benefits of that so long as you held your shares. So yeah, let me stop there. And
yeah, no, that's great, Greg. So what I might just ask you, like, just for the people out there watching, going in 5 years to 10 years, going from 4,000 to 24,000 feels like a really big jump. What's some of the assumptions behind that? Why it's making such a huge leap, even on the low end there?
Yeah, for sure. So the main reason for from 5 to 10 years is that we've got a number of companies that we've projected to take a long time to go through an exit, right? So if you can imagine a company going all the way through like a Series D round of investment and then exiting, we've projected that to take like 8 years to happen. So in your 5-year model, some of the companies that will exit at larger valuations, they're not even in there. It's not until you get to the 10th year that you'll have any of those even pop. And the difference between that kind of the low, medium, and high valuations is just the expected valuations that we're putting on these portfolio companies at these different stages. The good news is that we have no unicorns. We don't need companies to exit at like $1 billion. Traditional venture capital firms, that's usually what they're after, quite frankly, right? They invest quite a bit of money at quite a high valuation. And so in order to get a return that makes sense for the venture capital firm, they need these companies to exit it, in the hundreds of millions of dollars. The beauty with the venture studio model is that we own these things outright from day one. So we invest at the earliest stages. So, if we put in on average like $250,000 into any one of these portfolio companies, we don't need them to exit at like $500 million or $1 billion or $5 billion to make a lot of money, because we own so much of them. So, but back to the low, medium, high, most of these are sub 100 million in terms of an exit valuation. And the ones that take the longest, I think the largest one we have in the model is a few hundred million. And that's a very few that actually go through that, a very small percent. I think it's less than 5% actually we project over time to go through that. So most of these are early exits, which is the sweet spot in the acquisition world. Sub 200 million is the sweet spot for acquisitions. And that's where the vast majority of our portfolio companies are projected to exit at.
All right, great. So we've got a couple of questions starting to come in. So Rumi's asking, do you expect to pay dividends from the company's financial outcomes annually? So what's the frequency that we expect to pay these notional dividends, if you will?
Yep.
Greg?
Yeah. So it's only once the companies go through an exit event. So if they're generating revenue, they're being left alone to kind of build and grow and do what they need to do to create value. When the companies go through an exit event, that's when we make distributions out to the shareholders. So it would not be on a regular cadence. It would be just as and when the portfolio companies get acquired or go public.
This is another great question. Lots of them coming in from Kevin here. Is there a max number of distributions one can receive? So individual invest something like $5,000. Yeah, right. Yeah. Exactly.
No. And that's the beauty of this model that's been put together. And I can't take credit for it because I joined after it was already there. But this is really slick the way this works. And so no, if you hold your shares, you will receive distributions every time they're made.
Yeah, I think
and by the way, it's the same construct for the team, right? So just to be clear, there's no different in how like the founders, the executive team, and the investors are treated in terms of these distributions. So we're all interested in, and all of our upside is tied to distributions as well. So we're all interested and eager for this to happen as much as the investors are.
Absolutely, yeah, right. And I think you say it's one of the fascinating things about this model is if we have 50 companies in our portfolio and 25 of them exit all in 1 year, that's 25 checks in the post. That's going to be a good year for everybody. And like you say, and we're all similarly incentivized. Your shares, my shares are no different than the shares anybody who joins the crowdfunding will have. So we're getting lots of great questions here. So Adam's asking, Greg mentioned that Nobody Studios would own these companies outright. Does that mean the Nobody model includes partnering with investors or groups on the investment? So just maybe share a little bit more about that.
Yeah, I'll clean that up a little bit. What I was emphasizing is kind of day one. If we take a project off the whiteboard, we obviously own that 100% project 100%. But as you bring in, investors and teams, our position would actually, would be reduced. But to answer the specific question about are we looking to partner with other people? Yeah, it's actually been really encouraging and appealing as to how many companies we have coming to us wanting to partner with us with their ideas. So in other words, rather than go off and do this on their own, they want to partner with the studio, be acquired by the studio, still work for that particular project, but build it within the studio. There's a lot of benefits to entrepreneurs who are looking into that because we treat them almost like the investors in that they're going to participate in everything we do, not just a particular project. There's some other interesting components for entrepreneurs. So yeah, we are interested and eager to partner with other companies or individuals who have ideas.
Yeah, no, I love it. And great, the questions are just flowing in here, Greg. You're like the most popular question we've got of the week.
Oh, is that right? All right.
But as an investor, how long do you think one needs to wait for the payback, right? And their sort of paychecks, if you will, start to arrive. Share a little bit about that.
Yeah, that's a super excellent question. So we're kind of in the 3 to 5 year time frame. We think, as you can imagine, like we have 15 companies in various stages of development, either in the market or they're still being worked on in the studio. But as the companies grow, the numbers grow, right? Then things tend to compound. So like the first year or two, it's not likely we'd have an exit event. It's probably likely in the third year that we would have one. And so the size of that event will dictate whether or not, investors are going to get their money back at that time or not, right? Could be a quarter, could be half, could be double. But we're kind of targeting that 3 year time frame. again, if you think about this, we're also incented to have exits. So even if a company is trending well, and we know that if we held on to it for a while longer, it might be worth a lot, that would be a source of funding for the studio. So we are encouraged ourselves to have early exits take place, because we'd rather that than take in outside investment and get diluted, right? Because we're in the exact same position as the investor. So I'd say it's around that time frame. That's the target.
Yeah, I think that's a really great point, right? Recognizing that our model is not actually about trying to build these huge companies and waiting a long time for them to happen.
Yeah.
It's high velocity company creation, but optimized for early to mid-size exits. So we recapitalize essentially the studio to keep building more stuff, which is, the days we dream about. Loads of so many questions coming in there. This is from Jorge here. Can we reinvest dividends as an option? Great. So wants to keep playing if we start seeing success.
Yep.
Yes, great.
Yeah. Hey, Jorge, good to see you. So the answer is we're working on that. So we have some really large funds that are involved. We're going to be making some announcements, and that's their number one question is, how do they keep the money in the Nobody Studios ecosystem and just continue to deploy it? So we are looking at those types of things. If you look at our model as it stands today, we are investing in the very earliest stages of a company, and then we're spinning them out to be invested in by third parties. But what we're looking at possibly is creating a fund to do that with our current investors. And so we're trying to develop opportunities to where dividends could be reallocated into those funds to be invested into the companies that have the highest probability of success. They're on a high trajectory, ones that we want to double down on. So there's that, and there's a couple other things that we're looking at to do that very thing. So,
well, it looks like Jorge's been inspired by our presentation, and he's going to become a nobody. So, Jorge, thank you very much.
No, it's great.
Every person that contributes, becomes part of this crowd, is really powerful. And yeah, go to republic.nobodystudios.com. We'll be delighted to have you as an investor. We also have Scott Mason as well thrown in, saying he's pretty keen to get involved. And this is really exciting, folks. It means a huge amount when people get inspired to support this business and what we're trying to do. I think it's highly innovative what we're doing, both from a financial management point of view, but also from the company creation point of view, and giving people a chance to be part of early stage company ownership and creation is a huge part of our mission. So excited to have you.
Yeah, I'd just like to say too that for everyone out there, this is fun, right? It's super fun so far. It's only supposed to get more fun. The team is rock solid. Everyone's, eager and interested in working on the challenge. So, and as investors, unlike a kind of a traditional venture capital firm, which I hope I'm not coming across as bashing, because we're partnered with them. So, yeah. But unlike, it's just a different model. And in that model, it really is kind of, you're a passive investor. With this, you can get as involved as much as you'd like, up to and including bringing us your ideas and participating. So, it should be a fun ride.
Damn right, yeah. So, maybe this question from Robert here: does the investment share carry a value that long-term could be sold or transferred to somebody else? So,
yep. Yeah. So our current plans, and we don't know what's going to happen 4 or 5 years from now, but our current plans don't include us going public to where the studio's shares would be publicly traded. But you absolutely can transfer them, or you can sell them. And yes, you would expect that if we do what we say we're going to do, the value of those shares should increase dramatically. I mean, if we're kicking off distributions like we projected, the value of the shares would be worth a lot. And we also, as a part of what we're looking to do with the studios funds, is we're also looking in over time is to start doing buybacks or buyouts, I should say, not buybacks. That would suggest it's at the same price, but buyouts of people who want to exit all or a portion of their position. And so there'd be opportunities for that. If we do that, there'd be opportunities for all the investors to participate in that if they would like. So.
Great. And then I think we had one other question from Remy wanted to ask again. How many companies are revenue generating and P&L positive at the moment?
Yeah, so the studio was launched around 2.5 years ago. We've got one that's out generating revenue. None are P&L positive, or I should say, profitable at this point. And there's a couple others that have entered the market. So yeah, that's the stage. They're all early stage at this point.
Yeah, exactly. Yeah. Oh, early stage. Here's another great question. Is there a target range of seed round investment that nobody is aiming to make? Realizing, of course, there's a wide range of companies and startups and so forth that the capital needs that might go with that.
Yep. So there is, and it will ebb and flow. But on average, we're looking at around $250,000. If you listen to Mark, he's got double the number of startups I do. He's done 14. I think that's impressive. But if you listen to him talk, he talks about how it really is the worst thing for companies at kind of an idea stage to get massive amounts of money, right? It's wildly distracting. You spend more time thinking about how you're going to build out your office and the paint on the color and the furniture than you are like just, in the trenches trying to create something that's got value as rapidly as possible. So our model it's one that we've developed internally. It's a progressive model. Barry, is more qualified to talk about than I, but our model is all about a distinct set of milestones that we want to have these companies hit. And if they don't, then we bench them, right? To be more graphic, we put a bullet on them. So, and for those that are on a trajectory hitting those milestones, they'll get more funding. So it will ebb and flow. But like I said, we're interested only in taking companies from the kind of the whiteboard phase to market validation phase early on. And at that point, we're looking to get them funded from third parties. And so that's why that amount is at the level it's at.
Yeah, brilliant. All right. Well, listen, Greg. For an accounting show, this has probably been the most amount of questions that we've had on one of these live streams. So, you can take that with you as a little motif to stick up there in the back of your beautiful office.
Yeah, that's good.
It's been fantastic to have you on the show. I'm sure we're going to have you back again. I think this was really just our first step into just helping people understand what is this space about, what is equity crowdfunding, and then the unique opportunities that are available or will certainly be offering to folks here at Nobody Studios. And if you've been inspired by what we're doing, please share our story, this video. It'll be available on the line for as long as you want with anyone in your network. And if you have been inspired and you want to become a Nobody, make sure you go to republic.com/NobodyStudios and become a Nobody. It's going to be, as Greg said, a wild ride. We're looking forward to having you all with you. And look out, make sure you follow us on LinkedIn, Twitter, all the various channels. I'm guaranteed we're going to get Greg back again to talk a little bit more. I'm sure we'll dive into more of our models, which is fun. Thanks everybody. I love to see everybody really enjoying and excited about what we're doing and the discussion that we're sharing. It's been great to have such engagement with everyone. Look forward to seeing you again soon. Thank you very much.
Thanks everyone.